Natural gas prices are climbing higher on Friday as bullish traders aim to extend this week's breakout beyond the critical $3.50 pivot level. The main catalyst for this rally has been colder than anticipated weather forecasts. The latest 15-day weather model indicates a sharp temperature drop, strengthening expectations for heightened heating demand. According to the forecast, Arctic air is set to sweep across much of the U.S. in the coming week, driving temperatures below zero in some regions and sustaining high national demand. Overall, strong natural gas consumption is anticipated in the days ahead. Meanwhile, yesterday's EIA storage report showed a 100 billion cubic feet draw for the week ending February 7, landing at the upper range of market expectations. This decline brought total working gas in storage to 2,297 billion cubic feet, putting it just 67 billion cubic feet below the 5-year average. While the report initially fueled bullish sentiment, it has triggered a short-term pullback, just as I anticipated in my previous forecast. With robust technical support, colder temperatures, and a tightening storage outlook, natural gas prices have room to push higher. However, for a sustained rally, continued cold weather and constrained production will be essential. At the same time, short-lived freeze-offs had little impact on overall production, which remains on an upward trajectory due to strong prices. Over the past 4 weeks, output has steadily increased, surpassing the record high of 106 billion cubic feet per day for the last 2 weeks. Moreover, the gas rig count, a key indicator of future production, continues to edge higher, adding another rig this week. So, what does this spell for natural gas prices in the near future? Once the cold weather-driven speculative frenzy fades, the market will be left in a dangerously overbought state just as early spring threatens to slash gas demand, all while production keeps churning out record highs. At that point, reality will hit hard. And let's be real, you don't need a crystal ball to see what happens next. Some might argue that lower storage levels, currently around 2,300 billion cubic feet, are the reason prices keep climbing. Oh really? Let's take a little trip down memory lane to February 2019, when storage levels were even lower, dipping below 2,000 billion cubic feet. And what do you know? With storage capacity utilization at just 44% back then, compared to 54% now, Henry Hub prices were sitting at a mere $2.61, versus today's lofty $3.94. But sure, let's keep pretending storage is the main driver here. The natural gas market has seen a strong rally over the past week, breaking above the $3.50 level and now hovering between $3.50 and $3.80. While this has provided a solid boost, we're nearing the end of the cold season, which means traders may soon start reconsidering their positions. However, let's not forget, in just 10 to 12 days, we'll shift to trading the April contract, which naturally shifts the focus toward spring and weakening demand. From a technical standpoint, the $3.80 level provided pretty strong resistance, and don't forget the weekly chart did show a massive collapse a couple of weeks ago. So if the weather forecasts turn warmer over this long weekend, we may see a price reversal next week, if not to say collapse, taking in account the current overbought condition. Overall, the intermediate trend is supported by the 50-day moving average at $3.15, while the long-term trend remains positive above the 200-day moving average at $2.75. On the weekly chart, the price appears to have bounced off the 200-week moving average and is now making its way toward the 100-week moving average support. Please like, subscribe, and comment to support the channel. See you in the next one.